Okay, good afternoon, everybody. Today is April 21st, 2023. This is your weekly take on the market. I'll be your host. My name is Scott St. Clair, the manager of the Premium Product Group here at IBD. Take a moment to read the disclaimer, please. I'm not licensed. Nobody at IBD is licensed. We don't make buy, sell, hold recommendations. Certain things we can or cannot say. On a video like this, I can speak more freely due to the disclaimer here. So please take a moment to read this. So we'll go through market thoughts. I don't have a whole lot going on in the market. I think it's been a pretty quiet week. Industry groups, stocks to watch, quote of the week. So the usual routine. Another chart on breadth that I found from Morgan Stanley, and it's I don't know if you'd say the worst, but the lowest is the word they use. So you can see how bad breadth has been in this market. I don't know what that means. I don't know if that means the indexes have to go lower, or if that means that we've got this kind of stealth bear market under the surface still that we've had for a long time. So there's just not a lot to buy. It's not a terrible market, but it's not an exciting market, at least not the way that as far as ideas that I'm looking for. It is what it is. You trade the market you have, not the one you want. So this is the market we have. So you have to go accordingly. So I get a lot of questions like, is this a proper trend line I drew on XYZ? ABC gapped down on earnings. How was there a way I could have known about that? ABC gapped up on earnings. Is there a way I could have known about that? And on and on. So we get a lot of emails, and unfortunately, most of the time I have to give you the standard answer is I can't answer. I can't talk about process or what stocks you should buy or hold, or how you should, how many stocks you should own, et cetera, et cetera. Especially via email. So, you're welcome to email, but unfortunately, a lot of times I have to give the standard answer. But this week I got an unusually large number of emails about process. This is what I did. Was this process okay? And I think it's natural for us to equate what was the outcome, therefore the process was good or bad. So in other words, if the stock went down, the process was bad. If the stock went up, the process was good. And that's not always the case. So here's a simple quadrant. You have a good process and you have a good result or outcome. And that's really what you're striving for, is good process, good outcome. But are you going to have that all the time? No. So you can have a good process and a bad outcome. So for a stock that was building a base and was acting okay, FOUR, and then had a really bad day. Why? Well, somebody came out and it was a short sale report on why they felt the stock was a short. It's just, kind of bad luck, so to speak. You didn't know that guy or girl was going to come out with that report. So if your process was good, this is a stock that showed up on your radar, that everything about it, this is how I like to buy them, et cetera, et cetera. It was good process, bad outcome, right? You can have a bad process and get a good result. So, you could do something that, you're buying on the way down, and the Fed cuts rates in the middle of the day. That happened to a friend of mine a long time ago. The Fed cut rates at 12 o'clock Pacific time, and he was buying the market on the way down. Now, I don't know if that's the way his process was, but I don't feel like that was his process. His process is mostly to buy on the way up, but he felt like, the market was oversold or whatever, regardless. So I'm just going to say that it was a bad process, but he got a good outcome. So it's a bit of luck, right? The Fed cut rates in the middle of the day. or you can have a bad process and then a bad outcome or result, which is inevitable. So the key here is there's a book, Annie Duke wrote a book, and lots of people write books on this, but Annie Duke's book is called Thinking in Bets. That's really how you have to think about the market. Every trade you make is, I don't want to use, I know the word bet has kind of a negative connotation. If you bet a football game, it's, it's binary. You either win or lose. I guess you could tie, but it's all or none. Whereas in investing, it's not an all or none bet. You can get out. So bet's not the best word, but I'm going to use that word. So you have to, and she uses it for her book as well. So you have to think, each time I put money into a stock, it's a bet, and that's I want to make good bets, and I can't. All I can control is the process. I cannot control the outcome, and so focus on process. Don't worry about the outcome. Now, if the outcome is poor over and over and over, then you need to do some work and find out, is it truly a good process? Is this does this process have repeatable results, et cetera? So I thought this is important because of the kind of the questions that I get, Ford gap down, XYZ gapped up, SWAV had, rumor of a buyout today and the stock was up a bunch. Now if I bought SWAV on a good process, the outcome was good. There's a little bit of luck there, right? So, but I don't want to buy it expecting a buyout on Monday and then not get the buyout. So that would be a bad process and a bad outcome. If I buy it strictly to sell it on Monday higher, hopefully that would be a bad process. Now, if they get bought out, that's a bad process with a good outcome. I got lucky. So you get the idea. All right. Okay. So let's jump to, before I go to industry groups, we are going to pause my screen and I'm going to bring over the indexes and I'm going to resume the share. Okay, good. So the NASDAQ's super quiet here. 1, 2, 3, 4. These are the 5 days. It basically went nowhere. For the week, I bet it's up a tiny bit. I'm sorry, this is the S&P. So for the week, it's down 0.1%. I mean, look at that bar. You can barely even see it. It looks like nothing. So the market's getting super coiled and tight. Normally, I would say that you could have kind of an explosion out of this range one way or the other. It's possible. I don't know. Maybe the market is just going to be quiet for a while. It's kind of, there's a lot of reasons to be bearish. I feel like, I like, there's a few places I use for sentiment. Podcasts, a lot of podcasts that I follow. I don't actually listen to them all. I follow a lot of them. And if the guest sounds interesting, I'll listen. But sometimes the headlines is just enough. So I'm constantly removing downloaded podcasts. I probably listen to 1 in 3, 1 in 4 of them, but I like the headlines. I like to see what people are talking about. Like gold. I'll bring up, for me, gold was a short-term sell a handful of days ago because there was a lot of talk about, the dollar losing its, reserve status, which is something that will take years and years and years if it's going to happen. And so it just felt like, gold was on too many people's watch list. Therefore, it doesn't have to go down, but the probabilities are higher in the way I look at it. So podcast, Twitter is a great place. So I follow a lot of people and I just like to, kind of scroll and see what the sentiment is. Are people bullish? Are they bearish? And there's a lot of reasons to be bearish. And what bothers me from the bearish side is when you know the reasons, it's probably mostly built in to the price of the market. So all the reasons for why the market's going down or should go down, probably built into the price. And I feel like there's a lot of people positioned for stocks to go lower. Even Wall Street strategists and YouTube is another place. See, I can see the headers, you know, follow, you can see the header, XYZ analyst is on CNBC and he expects stocks to go down 10% or whatever. So you can, that's another great place for sentiment. And you don't have to watch all the videos. Like I said, just the header alone can be enough. So that's the problem I have with market going down. But also, you know, a lot of these reasons are real, and the market just doesn't have a lot of oomph. There's just not a lot of upside. The only time it seems to go up is strong, like I'd like, is when it's after it's sold off. So you get this boom, we're down here, and it's that type of uptrend, right? Boom, and so you're gonna move up. This isn't too bad, and then but you know now it's gotten real quiet. And with the Nasdaq, you know you can see it's a lot of intraday back and forth. It's like, you know, so you get all this, and in the end, it's, you know, it's 3 days later, it's gone nowhere. So it's a lot of that going on. So I am indifferent to the market as we sit here. If the market went up, it wouldn't surprise me. And if the market went down, it wouldn't surprise me. So I'm trying to focus more on the individual names. If I think the stock's a buy, I buy it. If I think the stock's a sell, I sell it. And if I think the stock's a short, I short it. And then I'm just going to see, am I making progress? Is that working? And if it's not working, then, you know, I need to figure out something else or, you know, do nothing. So I just don't see a lot of story in the indexes as we sit here. So let's pull up gold like before. So here's where, you know, you heard a lot of talk about, you know, gold and the dollar losing status, et cetera. And, you know, if you're buying gold because you think it's going to go up 100 points in the next 5 years, this is just total noise. But for someone like me, who's usually concentrated in position, that noise is enough. I need to avoid that, at least mostly, if with the size that I normally would have, or I don't need to, but I'd like to avoid that. Is the right way to phrase that. All right, so let's look at the. Is there anything else I want to talk about in the industry or the indexes? I don't think so. So let's go to the industry groups. And semi-fabless is one. This might change after today a little bit, but building residential is two. Another great story, right? Everybody's telling you housing has to slow down, yet the group and the stocks are on fire. It's just total dichotomy between the news and the stocks. Maybe the news finally catches up to those stocks, but in the end, so far they've held up super well. Mining gold even is number 4 group. There's a lot of potential setups there. The problem, for lack of a better word, with gold is, to me, every setup is all the same. There's almost impossible, in my experience, to know who's the leader in gold mining. I just don't know. So, you know, you'll probably win with any you pick and lose with any you pick, depending on what the metal does. But I do own a stock in this group, and we'll talk about that, I guess. Computer software education, leisure travel booking, medical products, apparel, shoes, pretty good. On-ons holding it really well. Crocs, leisure gaming, etc. So very diverse. There's lots of things to pick from. There's some of them are going up, and some of them are, you know, backing and filling. And you know, I think the main thing is, are you making progress? Are you putting points on the board? If not, you know, pull back. And if you are, you can add, you can start pressing. So let's get into stocks, because I have quite a list of them. TMDX broke out today. I didn't know much about this one. Organ transplant, no earnings, but really powerful breakout. I really like these type. I know I don't own this one, unfortunately. It wasn't really on my radar, but I really love the setups. I don't know what it is. I just really enjoy when they shake out like this. Like if I were to backdate this chart to 414, so like to me, that looks like stock's going down. Like that might even be something I might even consider shorting, right? So it's supposed to go down, and then we advance one day, and it doesn't. It regains all of the action from the previous day. Now, if I was short, I would get knocked out of the box for sure. But if I was looking to buy, I would be very intrigued with the fact that it undercut that low and didn't go down. And then the next day, pretty good action. And then this is really good action. I like the fact that you see how it tried to go lower, almost undercut the previous day and couldn't. And I might buy that. If like this was a name I really was interested in, I might start a position there, like 5% position. And then, I'm piling in. Now I'm full position, whatever that is, 10, 15%, whatever that is. Because this stock was supposed to go down and didn't. And that's how you can get into them if you're aware of them. Now, I was not aware of this name, and so I don't have any real-time, and analysis of hey, this is exactly what I did. But and there's a little bit of hindsight. If I'll give you that for sure. But this is how I'm always looking. These are my favorite setups like that. And I don't mind buying like this, but I prefer if I can get some here and some here, then I will, add there. And so if I have 500, I can buy 200 here or something like that. Really try to, press if it's a name that I'm interested in. So that is a very interesting name. ISRG, get back to today's date. Am I there? Okay. That gapped up on earnings report. Now, this is interesting to me. I love what ISRG does, robotic surgery. And this company's been around forever. They're the leader. Look at this. I remember this is a name that people used to talk about when in the 2000s. Look at how it came out after the big bear market. Let's size this to best fit. And, so it goes public like the absolute worst time, 2000. Gets hit really hard and then comes out of a large consolidation there. But man, when they make new highs like that after 3-4 month basis, and that's telling you something that's pretty good. So this is a really strong breakout. I don't know, the earnings, that's not that exciting to me, up 9% on revenue, up 14%. So I wish the stock acted a lot stronger than the earnings were, which I think is, I guess that's better than if the earnings were up 99%, revenue up 45%, and the stock was barely up, right? So maybe going forward, they see a big increase, but this is a very interesting stock. It's big, liquid. Let's see what sponsorship. And the other thing is, like, I don't very rarely will I buy the first day of a gap, but I don't mind buying them day 2, day 3, day 4 after a gap if they can't go down. So far it's held the gap. So that's interesting to me. On the home builder side, the market is packed with them. So Lennar, huge cup with handle here, smaller cup with handle here. Looks very good. And I think MTH broke out of this large cup with handle. So I don't know. I see what everyone else sees. It feels like there's a massive slowdown in housing, but the home builders are not, they're not acting like that. So it's very interesting the way that this has played out, right? Because down here is probably where it was super obvious that interest rates were too high, or I don't know, that's not the right way to say it. It's that interest rates, mortgage rates were much higher, and yet the stock is up, 40, 45, 50 points from there. So, conventional wisdom would have said lower, and they didn't. That's what I love, when conventional wisdom says the stock should do this, and then it doesn't. It does the opposite. I find that to be a higher probability setup. So I don't own any home builders. I've kind of missed the boat there because I've been swayed by the conventional wisdom. But at least I haven't done anything silly like short them. SCCO, so it's holding up pretty well. Again, shakeout, double bottom, shakeout +3 buy point. Today was a little bit, it wasn't great, but not as bad as it could have been. FCX had earnings today, and they weren't all that great. At least the market didn't like them. So FCX, this looks like a double bottom to me, but it's kind of lost that. But the market didn't like this, and so SCCO got hit on that. The good news, I don't own either one. I have owned SCs. I have owned both of them, but I didn't own them the last couple of days. And I think well, you've got earnings here, so I don't want to speak too soon. But to me, if I'm going to go back to this group, as Southern Copper is the one versus FCX, at least based on the action that I've seen. 4. Now, you can't see the ascending base. I'm going to backdate it. And, and I'm just as guilty as anybody. I love buying them early. But when you see an ascending base, you want to wait for it to actually start to go up before you buy it. So it's telling you that there's the potential for this pattern, but I probably would wait until it actually starts up at least a little bit. I prefer always to buy them on the way up. When I was on the portfolio management team at William O'Neill and Company, one of the main portfolio managers told me that, because I told him I always prefer to buy them on the way up. And he said, "Oh, Bill always did that. Bill always preferred to buy upticks, so to speak." So, and then, it breaks. And this is what I talked about. It's just kind of bad luck. Now, what's your process? If your process was to buy it off the 50-day, then you had good process, bad outcome, kind of a bit of bad luck, right? If your process is to buy the base, the breakout, then you had bad process, bad outcome. You were trying to sneak in a little bit. So, and that's fine. I'm not saying that's wrong. I'm just saying, understand, have what your process is in that regard. So this pattern looks broken, and could be a shakeout. I don't know. Numbers are super strong here. So this stock's been on my radar forever, but I will tell you, let me scale this. It's just been a really difficult stock to trade. So here pulls back, here pulls back, here pulls back, here pulls back, here really pulls back. Do you see how tough that stock was? And I was in there a lot in this time frame, and I don't remember ever making any real money in this stock because it just was too hard to hold. So it's kind of a little bit of the same now. Pull back, up, pull back. I just find it to be a tough stock to trade. Maybe maybe it's probably one better suited for just holding on. And then Suave. There was news that Boston Scientific might be interested in this company, and that led to that big spike right there today. We'll see. I'm not a big fan of this huge cup, 46% deep. At this point, once it does this, if you don't already own it, you got to wait for some type of handle. And if they get bought out, they get bought out. You just, I don't know how you would be able to trade that. And now let's look at the big boys. So Apple's really, kind of shaking off a lot of bad news. The Taiwan Semiconductor bad news. I think there was some kind of report today about phone shipments or something, but stock never really goes down. So holding up really well. Amazon trying to turn up, Google. and Google finally got me. I just kind of lost patience, which is the problem. I just know, I'm buying it here, and that it's closed strong. I endured a few days of weakness, closed strong, next day gaps down. I just get tired of that. So I've moved on. We'll see. I might go back to it. I might not. I might just say, chuck it up to a stock that doesn't fit my trading personality. And NVIDIA, probably the best stock in the market. You got liquidity, you got institutional sponsorship. Don't quite have earnings and sales just yet, but you've had those big numbers before, and they're in all the key buzzword areas. So earnings not for a while. I don't know. Maybe a pull back to the moving average is a possibility if you're interested in NVIDIA. And then last but not least, Tesla, which if I go to a weekly, you can see like this is first time in a long time you've had red right there. And now maybe way back there was red, but that's pretty nasty looking quarter. You can see the deceleration is pretty bad. The deceleration in revenue is 56, 37, 24. How I feel about Tesla. I'm short the stock. I think it's just a pretty good car company, and so it should trade at some type of multiple to other car companies, but not 7 times Mercedes or 8 times BMW or whatever the number is. So it gapped down on the earnings report, and today it did not a whole lot. So this looks weak to me. I am short this one and have not covered it just yet. Okay, all right. So pause the share. Resume the share. Back to the slide deck, quote of the week. And has a lot to do with that process and outcome. Bill Eckhart, New Market Wizards. The desire to maximize the number of winning trades or minimize the number of losing trades works against the trader. The success rate of trades is the least important statistic and may be inversely related to performance. So I love, like, I have a thought process to what I think is the right way, but I also would rather have somebody like a Bill Eckhart or Paul Tudor Jones or somebody confirm the way I'm thinking is correct. I think batting average is a terrible way to view success in the market. So let's use the baseball analogy. There's batting average and then there's slugging percentage. And you want to have a high slugging percentage as a trader. So your batting average is you come to bat 4 times and you get a hit 1 time. You get out 3 other times, your batting average is 250. If you get a hit 1 time and you get out twice and you walk the other time, the walk doesn't count, so to speak, in your average. So you're 1 for 3, and now your average is 333. The slugging percentage measures how many total bases you get. So if you go, let's make it easy. If you go 2 for 4, you're batting 500. But let's say you have 2 singles and 2 outs. If you go 1 for 4, but you hit a triple, you've got 3 total bases versus the 2 other. So you can see how that's more valuable. And that's what slugging percentage is, basically just measuring the magnitude of your hitting. If you're getting a lot of singles, you could have a good average, but you really want a high slugging percentage. You're getting doubles, triples, home runs. You're getting multiple bases when you get a hit. That's the key. That's the same with trading. You don't have to be right even half the time to make money in trading. If you could be right literally 1 time out of 10 and make money. Let's say you put on 10 trades and you lose 10% in 9 of them, but the other one went up 300%. You would be up, if you started with the same amount of money. So that would be hard to do, but you would be that. So, having, I think you really probably want to shoot for something in the 40% range of winners, and then measure your winners. What's the average win rate versus your average loss. So when I'm right, if I'm making $3 and when I'm wrong I'm losing $1, then and I do that 40% of the time, you're going to do really, really well. So and it comes back to that process. So don't worry so much if you have a good outcome, or good process, I should say, and a bad outcome, because that's going to happen. You just move on from it and just keep repeating those good processes, and you'll have plenty of good outcomes. And some of those good outcomes might be amazing outcomes, outsized outcomes. That's really what you're looking for. And I'm not saying you have to do that every time. Every stock has to be a winner. My goal, what I believe is so let's say I put 10 trades on and I get 6 wrong. So those are going to be cut pretty quick. I've got 4 winners. 3 of those 4, I'm going to look to sell fairly quickly by most people's standard, like within a 2 to 5 week window. I'm going to look to take 10, 12, 15, 18, 25%, whatever the market gives me. As soon as I think it's lost its steam, I'm going to look to get out and take that. Of those 4 winners, one of them I'm going to try to hit a home run with. So let's say I'm up on XYZ 19%. I think it's a fantastic company. I think it can be a big winner. I'm not going to take the 19%. I'm going to risk half of that gain or 3/4 of that gain or something like that, with the idea to try to make 40, 50, 70%. Sorry about that. And for some of you out there, that might be making 100, 200, 300%. I wish I had that patience, to do that. I've never had a single trade do that. I might go back to the well in that same stock, but never a single trade. But that's kind of what my objective is. So really, of the 4 potential winners I might have, I'm really only going to keep one for a big winner. And, and sometimes I'm not going to pick that one right. It's going to fade out or fizzle, and I might have to take a 5% gain or 8% gain, or maybe it comes all the way back to what I owned it at, and I've got to take a get out even. And that can happen. I know that that's the risk, but I'm going to risk that gain to try to make a big winner. So I think you should do at least the bare minimum that. Now, a lot of you probably are looking for it. I find from my experience of speaking to people is they have the opposite problem of me, is that they tend to hold on to the winners too long, and they roll over and they give back all their gains. So you probably have to have a rule that if you're really looking for the big winners, you just can't stomach selling them. Use the opposite, like a 3 out of 4 rule, the other way. So you have 4 winners, you're going to keep 3, but you're going to sell one. Sell one of them so that you can pay for the losers at least a little bit, if not all of them. And now you've got those 3, and maybe you catch a home run. So it just depends on your style, which way you want to go about it. All right, Marcus Smith at investors.com, 800-424-9033. These are our Twitter handles. Have a great weekend, everybody. Thank you, and we will talk to you next week. Bye-bye.